Hey there, have you seen the latest housing data? This makes absolutely no sense unless you dissect it. This is Dean Odell with 7 Gables Real Estate in the Odell Group. Welcome to Tustin Talks. We're going to talk about the Orange County market and we're going to try to dissect what's going on. So let's get started right now. All right, so let's start by looking at the active listing inventory chart year over year. We currently have 2,218 homes on the market. That's a decrease of 87 homes in the last couple of weeks. Today's inventory is the second lowest level recorded in March since tracking started in 2004. Last year at this time, there was only 1,406 homes on the market, and that was 37% lower than where we are today. To compare to a more normal market, we'd like to take a look at that 3-year average between 2017 to 2019, when there was 5,119 homes on the market. So I know what you might be thinking. You're looking at this and you're going, well, wait a minute. We only had 1,406 homes on the market last year. Now we're at 2,218. It's like, wait, what's wrong with that? We're up over 50%, right? Well, let me tell you what the problem is. We're going to show you on the next chart. Okay, so when you look at this historical chart for the last 10 years of inventory in the month of March, you can really see how drastically low we are in inventory right now. We usually have more than 4,000 homes at this time of the year, with some of the years as high as over 6,000. I like this chart because of the 10-year perspective. Currently, we are only at 2,218 homes, which is at least higher than last year, but it's still far below our average inventory at this time of year. Okay, what you're not seeing on this chart is actually what happened before March 2013, which was when we were coming out of the Great Recession. Now, if this went back further, you would see back then in Orange County, we even had 16 to 18,000 homes on during this time of year. So when you look at where we are historically, we're certainly nowhere near Great Recession levels. But what's odd is our demand, and that's what we're going to talk about in the next chart. Now, in the last 30 days, we've had 1,505 homes go into escrow, which is down 32 pending sales since our last update 2 weeks ago. Last year, there were 2,195 pending sales, which was 46% higher than where we are now. And prior to 2020, the 3-year average was 2,422, which is 61% higher than where we are today. These numbers can be really confusing because it depends on how you look at things. What's interesting about the relationship between active listings this year and demand versus last year is if you really break it down, our listing inventory is up, but our sales are down by 1/3. So to me, that signals there's an affordability issue here. Interest rates are taking effect and it is bringing demand down. In fact, demand is the lowest it's been since the Great Recession. Now, the reason it doesn't feel that way is because supply is still so low historically. Next, let's take a look at the average expected marketing time year over year. Currently, our days on the market for Orange County is 44 days, and that is a hot seller's market. This is the lowest marketing time that we've seen since May of 2022. Last year, we were also in a hot seller's market, but at a much faster pace of only 19 days. The 3-year average prior to 2020 was 64 days, which is about 2.5 weeks slower than today's speed. Okay, so what's interesting is if you look at this chart and what's happened over the last 12 months and you follow that orange line into the blue line, which is this year, the reality is the way that line has moved has been almost exactly how interest rates have moved. So we are in a market that is being controlled by interest rates right now. Now let's look at my favorite chart, which is the expected marketing time broken down by price range. If you're a buyer or seller in Orange County, this is the best way to see what's going on in your price range. You'll also see the various market types reflected by the days on the market. As you can see, not every price range has that average marketing time of 44 days like we looked at in the last chart. Everything up to $2 million is taking 48 days or less on average and is considered a hot seller's market right now. The $2 to $4 million range is a slight seller's market, and between $4 to $6 million is now a slight buyer's market for the first time since August. The $6 million range is still in a deep buyer's market, and we will have to speed up by 162 days in order for that to change. If you take a look at the percentage of current inventory to demand, you'll see that it is unbalanced at a few price ranges, especially in the $750,000 to $1 million range. The percentage of demand is 27%, but only 18% of the inventory. Another way to look at that is there's only 2/3 of a home for every one buyer. It's crazy. Okay, so now let's take a look at what all this data means and my advice for buyers and sellers. Okay, I'm going to start this with what we've been seeing out there. Okay, and what we've been seeing out there has been pretty crazy. Lots of offers, our listings are selling, our buyers are having a hard time competing with other buyers, right? So all these things that were going on last year are going on again this year, but just at a lower level. No 10, 15 offers, maybe 3, 4, that type of deal. So I'm thinking this has just lasted way too long. I got to get some advice from somebody who's outside my industry and is looking at everything on a world view. So I call my buddy who has been in the wealth management business for 30 years and only manages high wealth clients. And I say to him, look, what are you seeing? Because I've got this myopic view of the real estate industry, but I think I kind of get what's going on a big picture, but what are you seeing? So he says to me, Odell, we are seeing the first cracks with the consumer. The consumer is in trouble. The average car payment is $1,000 a month. And he says, and delinquencies on credit cards and car payments are through the roof right now. When people start not being able to make those payments, they got to figure out where they're going to get that money from. And I said, well, that's fine. I said, there's lots of equity in homes. Won't people just take the equity out of their homes? He says, yeah, but for how long will they do that? And what if layoffs begin? We're seeing a recession in 2024. That's what we're seeing. So anyway, I'm not trying to scare anybody here. I'm just trying to make everybody realize that if you think there's anything different about this real estate cycle than the last real estate cycle, don't believe it, okay? Things go up, things come down, and this cycle will end, okay? So, and it's way overdue to change. So buyers, my advice for you guys, be patient. Don't buy anything unless you're planning on staying there 5 to 10 years. Get something that's going to work for you long term. Otherwise, your life may change. You might start having kids, all these things, and now all of a sudden, the property you're in doesn't work for you. The big down payment that you put down is now cut in half because the prices have gone down and you now want to get your equity out to move up, right? So all these different variables, right? So just make sure that if you're buying right now, you're buying for the long. Don't buy and think, oh, in 3 years we'll move up. Well, in 3 years, it might not be as easy to move up as you think, okay? Sellers. Now, I don't want you guys to think I'm being negative Nelly here because I'm not, because things are still really good for you guys, but I'm telling you, there's just no way this goes on much longer. So mark my words, things are going to change and it's going to come swift when it does. So here's the advice I have for you. Now, I understand why you're staying in your home. For the same reason a lot of people are staying in their home. People don't want to move. There's no reason to move, right? But life changes. And if you have a backup plan or another place to go, all I'm telling you is now's a great time to get out. And if you're holding rental properties, okay, and you're getting into your later years, or you're somebody who just does not want to own rental property or be a landlord anymore, and you're holding it for the sole purpose that you don't want to pay capital gains on it, I'm telling you, you better do the calculations, because when this thing starts to correct and prices adjust, the value of your home going down could be easily the same as what you would pay in capital gains anyway. And now, by selling it in a good market, you still get to free up your cash and look at short-term rates. Look at treasuries. I mean, my gosh, you could put your money into treasuries and get 5%, right? Some of them have tax benefits to it. There's just all kinds of good options for 1 to 3 year type savings. And you need to compare that with maybe what your return on investment truly is on these homes that you might be holding, because you got to look at what's the value and what's my equity going to be when I take my money out and put it in a nice safe place and get a nice interest rate on it, right? So these are all things that I think it's time to really consider. And as far as your primary home goes, if you're ready to go elsewhere, couldn't be a better time. So anyway, that's it for this Tustin Talks. Hope to hear from you guys soon. Add your comments, subscribe, and we'll see you on the next Tustin Talks. Thanks. Bye-bye.